Before we dive in, please remember that I am not a financial advisor, mortgage broker, or certified credit counselor. This presentation is for educational and informational purposes only and should not be considered financial or legal advice. The mortgage and real estate industries are complex and subject to frequent changes in regulations and market conditions. You should always consult with a qualified and licensed professional, like a mortgage lender and a financial advisor, to discuss your specific situation before making any major financial decisions. You've been doing it for months, maybe even years. That late night ritual. You put the kids to bed, you finish the dishes, and you open your phone. Not to social media, but to Zillow, to Realtor.com. You scroll through listings, you save your favorites. You can picture your couch in that living room, your barbecue on that patio. You find it, the one. The perfect house in the right neighborhood at a price that seems almost possible. A surge of excitement hits you. This is it. This is the year. And then the cold water. The thought that's always lurking in the back of your mind. You open another app, the one that shows you that 3-digit number. Your credit score. And there it is. 602. 615, maybe 590. That dream of the backyard barbecue suddenly feels a million miles away. Your heart sinks. You think, it's impossible. No one's going to give me a loan. I'm stuck renting forever. You close the app and the dream dies just a little bit for the night. What if I told you that number, that 600-ish credit score, is not a period at the end of your homeownership story? What if it's just a comma? What if I told you that millions of Americans right now are living in homes they bought with a credit score in that exact same range? The difference between them and the person who gives up is not luck. It's not a secret inheritance. It's knowledge. They understood the rules of a game that feels rigged against them. And today, I'm handing you the entire playbook. This is not another vague. Pay your bills on time and your score will go up video. We are going to rip the cover off the entire process. By the time this is over, you will have a step-by-step, real-world blueprint for buying a house with a credit score in the low 600s. We are going to arm you with so much information that you'll be able to walk into a lender's office with more confidence than someone with an 800 score who hasn't done their homework. Here's exactly what we're going to cover. First, we're going to dissect what a 600 credit score actually means to a mortgage underwriter. Not what you think it means, but what the person approving or denying your loan is trained to see. We'll look at the story behind the number and how to frame that story in your favor. Next, we are going deep into the specific loan programs that are literally designed for you. I'm talking about FHA loans, VA loans if you're a veteran, and USDA loans. These aren't subprime or bad credit loans. These are government-backed programs created to make homeownership accessible. We'll break down the real, hard numbers, the minimum credit scores, the down payment requirements, which are way lower than you probably think, and the interest rates you should realistically expect. No sugarcoating. Then we're going to talk about the one thing nobody ever prepares you for. The money. Not just the down payment, but the closing costs, the prepaids, the cash reserves. I'm going to show you exactly how to calculate what you'll need, and more importantly, where you can get it, from down payment assistance programs to seller concessions. And finally, I will give you the single most powerful strategy for presenting yourself to a lender. We'll talk about building a team, finding the right loan officer, because not all are created equal, and how to prepare your file so it's so clean, so organized, and so compelling that your credit score becomes a secondary issue. The system is designed to be intimidating. The jargon, the paperwork, the fear of rejection, it's all meant to weed people out. The myths you've heard are powerful. You need a 720 score to get a good rate. You need 20% down or you're wasting your time. A 600 score means you'll be rejected instantly. These are the lies that keep hardworking people paying their landlord's mortgage instead of their own. Today we declare war on those myths. So let's start with the absolute foundation. Let's pull back the curtain on that 3-digit number that's been causing you so much stress. What is a 600 credit score? First, and I need you to really let this sink in, a credit score is not a measure of your worth as a person. It is not a grade on your character. It is simply a snapshot in time, a risk assessment tool used by lenders. That's it. It's a number generated by an algorithm based on your past financial habits. And because it's based on data, it can be understood, managed, and navigated. In the world of FICO, the most commonly used scoring model, a score between 580 and 669 is generally considered fair credit. Notice the word. It isn't terrible. It isn't impossible. It's fair. This is a crucial distinction. Excellent credit gets you the best rates with the least amount of scrutiny. Good credit gets you a smooth process. Fair credit means the lender just needs to look a little closer. It means they have more questions. It means they need more proof that you're a good bet. Your job isn't to magically jump 150 points overnight. Your job is to give them that proof. So when a loan officer pulls your credit report and sees a 610, they don't just stamp rejected on your file and move on. That's not how it works. The 3-digit score is just the headline. They immediately dive deeper into the full story, your credit report. They are looking for the why behind the score. Is the low score because of a high credit card balance that you've since paid down? That's a positive story. Is it because of a handful of late payments from 3 years ago during a tough time, but you've been perfect for the last 24 months? That's a story of recovery, and lenders love that. Or is it from a recent collection or a pattern of missed payments across multiple accounts? That's a tougher story to tell, but it's still not a deal killer if you know how to address it. The most important thing they are looking for is what the industry calls compensating factors. This is your secret weapon. Compensating factors are the positive elements of your financial life that help to balance out or compensate for the risk suggested by your lower credit score. This is where you shift the conversation from your past mistakes to your present stability. What are these magical factors? The first is a stable employment history. If you've been at the same job or at least in the same line of work for 2 years or more, that is a massive checkmark in your favor. It shows stability and a reliable source of income. It tells the lender that whatever happened in the past, your present is on solid ground. The second is a low debt-to-income ratio, or DTI. This is simply the percentage of your gross monthly income that goes toward paying your monthly debts, things like car payments, student loans, and credit card minimums. If you have a 600 score but very little other debt, you are a much stronger candidate than someone with a 680 score who is drowning in car payments and credit card debt. A low DTI shows you can comfortably afford the new mortgage payment. And the third, and perhaps most powerful compensating factor is cash. Having money in the bank. This can take 2 forms. A slightly larger down payment, even going from the minimum 3.5% on an FHA loan to 5%, can make a huge difference in how a lender views your application. It shows you have skin in the game. Even more important are cash reserves. This is the money you'll have left in your savings or checking account after you've paid your down payment and all your closing costs. Having 2, 3, or even 6 months worth of your new mortgage payment in the bank is a giant safety net. It tells the underwriter that if you hit a bump in the road, you won't immediately go into foreclosure. Your 600 score is just the entry ticket to the conversation. Your job history, your DTI, and your savings, those are the things that are going to win you the argument. And that's what this is. It's a well-reasoned, documented argument for why you are a worthy investment. Over the next parts of this presentation, we are going to build that argument piece by powerful piece. We're going to turn your application from a maybe into an undeniable yes. So let's start with the number itself. 600. It's not just a number, is it? It's a feeling. It's the feeling of a door being held just slightly ajar, but you're not sure if you're being invited in or about to have it slammed in your face. To a mortgage lender, that number 600 is a story. It's a summary, a headline of your entire financial history. And right now, that headline reads something like, potential risk ahead. Proceed with extreme caution. Our job is to rewrite that headline. To do that, we first have to understand what the lender is actually reading. They aren't just looking at the number 600 and making a gut decision. They are looking at the ingredients that bake that number into existence. This is the single most important concept you need to grasp. Your credit score isn't some mystical, random number assigned to you by the universe. It is a calculated grade based on 5 specific categories of your financial behavior. And just like any test, if you know what's on it, you can study for it. Think of your credit report as your financial resume, and the score is the one-line summary at the top. A lender is a hiring manager, and the job you're applying for is a 30-year, 6-figure loan. They are looking for someone reliable, consistent, and trustworthy. Your 600 score tells them you might be late to work sometimes, or that you might have some gaps in your employment history. It doesn't mean you're a bad person or incapable of doing the job. It just means your resume has some red flags that need explaining. So let's pull back the curtain on the FICO scoring model, which is the model used by over 90% of top lenders. There are 5 pieces to this pie. The first, and by far the most gargantuan slice, accounts for 35% of your entire score. This is your payment history. This is the big one. It is the undisputed heavyweight champion of your credit score. It answers the most fundamental question a lender has. When you borrow money, do you pay it back on time? Every single late payment is a ding against you here. A 30-day late payment is a problem. A 60-day is worse. A 90-day late payment is a 5-alarm fire. And things like collections, charge-offs, bankruptcies, or foreclosures. Those are catastrophic events on your report. Imagine you have a friend who constantly promises to pay you back on Friday, but sometimes pays you on Monday, sometimes the Friday after that, and sometimes not at all. How quickly would you stop lending them money? That's exactly how a lender views your payment history. It's the foundation of trust. With a 600 score, it's almost a statistical certainty that this part of your report has some blemishes. Maybe it was a medical bill that went to collections that you didn't even know about. Maybe it was a credit card you missed a payment on during a tough month a few years ago. It doesn't matter to the algorithm. The data point is there. And it's screaming potential unreliability. The second biggest slice of the pie, at a massive 30%, is called amounts owed. But what it really means for most of us is credit utilization. This sounds complicated, but it's incredibly simple. It's the percentage of your available credit that you are currently using. If you have one credit card with a $10,000 limit and you have a $5,000 balance on it, your credit utilization is 50%. Now, why does this matter so much? Because high utilization is a massive red flag for financial distress. To a lender, a person with maxed out credit cards looks like a person who is living on the edge with no financial buffer. They see someone running on fumes. If a small emergency pops up, a car repair, a broken water heater, that person has no available credit to handle it. So what are they going to do? They're more likely to miss other payments like their car loan or their new mortgage. Lenders want to see you using credit, but they want to see you using it responsibly. The general rule of thumb is to keep your utilization below 30%. So on that $10,000 limit card, you'd want to keep your balance below $3,000. For people with scores in the excellent range, 800 and above, you'll often find their utilization is below 10%. For someone with a 600 score, it's very common to see utilization ratios of 50, 70, even 90% or higher across their accounts. It's one of the fastest ways to tank your score, and as we'll see later, it's also one of the fastest ways to improve it. So right there, with just those two factors, payment history and credit utilization, we have accounted for 65% of your entire credit score. 2/3 of the entire grade comes down to two simple concepts. Do you pay your bills on time, and are you over-reliant on debt to live? For almost everyone hovering around that 600 mark, the primary issues live right here in these two categories. This is fantastic news, because it means we don't need to worry about 1,000 different things. We need to laser focus on these two Goliaths, because moving the needle here will create the biggest, fastest, and most dramatic change in your score. Now let's quickly touch on the other three categories because they do matter. The third slice, at 15%, is the length of your credit history. This is basically your age in credit years. It looks at the average age of all your accounts and the age of your oldest account. A longer history is generally better, because it gives lenders more data to judge your long-term behavior. If you've been responsibly managing credit for 15 years, that's a much more reliable track record than someone who just got their first credit card 6 months ago. If you're younger or new to credit, this can be a factor that holds your score down. There's no quick fix for this one. You can't just invent history, but its impact is much smaller than the first two. The fourth slice is just 10% of your score, and it's called new credit. This is all about how recently and how often you've been applying for new credit. Every time you apply for a credit card, a car loan, or any kind of financing, it typically results in a hard inquiry on your report. 1 or 2 inquiries here and there is no big deal. But if you apply for 5 different credit cards in a single month, it makes you look desperate. To a lender, it's a sign of risk. It suggests your financial situation might have suddenly worsened, and you're scrambling for cash. This is why you should never ever go on a wild application spree right before you want to apply for a mortgage. Finally, the fifth and smallest slice, also at 10%, is your credit mix. Lenders like to see that you can successfully manage different types of credit. There are 2 main types: revolving credit, like credit cards, and installment loans like a car loan, a student loan, or a personal loan, where you pay a fixed amount every month. Having a healthy mix shows you're a versatile and responsible borrower. It's not a huge deal breaker, and you should absolutely never take out a loan you don't need just to improve your credit mix. But it is one small piece of the puzzle. So there it is. That's the entire game. 35% payment history, 30% amounts owed, 15% length of history, 10% new credit, and 10% credit mix. Your 600 score is not a mystery. It is a direct result of your performance in these 5 areas. It's a snapshot of your past financial decisions. But here is the most critical thing to remember. A snapshot is not a life sentence. It is a single moment in time, and you have the power to change the next picture that gets taken. We've just done the diagnostic. We've identified the disease. We know that the problem almost certainly lies in a handful of late payments and credit card balances that are too high. We now know exactly where the battle needs to be fought. We're no longer just staring at the number 600 with a sense of dread. We are looking behind the number at the mechanics of the score itself. We're transforming from a passenger to a pilot. And now that we understand the controls, we can start to steer this thing in the right direction. The question is no longer, why is my score so low? The question is now, what is the very first, most effective step I can take to start fixing my payment history and lowering my utilization? That's where we're going next. We're moving from diagnosis to treatment. We're going to talk about the specific, actionable, and sometimes counterintuitive strategies to start cleaning up your credit report and immediately address the 2 biggest factors holding you back. This is where the real work and the real results begin. Alright, let's break this down. Your credit score is not some mythical beast. It's a number calculated from just 5 key ingredients. And the 2 most important ingredients, the ones that make up a whopping 65% of your entire FICO score, are payment history and credit utilization. That's it. 65%. If we can fix these 2 things, we're not just moving the needle, we're spinning the whole dial. First up, the heavyweight champion, the undisputed king of your credit score, your payment history. This accounts for 35% of your score. Think about it from a lender's perspective. Before they hand you hundreds of thousands of dollars, the single most important question they have is, does this person pay their bills on time? Your payment history is your answer to that question. Every on-time payment is a gold star. Every late payment is a red flag. A single recent late payment can drop your score by over 100 points. It's that serious. So, our first mission before anything else is to stop the bleeding. Effective immediately, you will never ever be late on another payment again. I don't care if you have to set 1,000 reminders on your phone, plaster your bathroom mirror with sticky notes, or train your dog to bark every time a bill is due. The single most powerful thing you can do for your credit score starting today is to pay every single bill on time. The easiest way to guarantee this? AutoPay. Go into every single one of your accounts, credit cards, car loans, student loans, everything, and set up automatic payments for at least the minimum amount due. The minimum. This is your safety net. You can always go in and pay more manually, but this ensures you will never get hit with a 30-day late penalty because you simply forgot. This is non-negotiable. It's the foundation of the entire house we're trying to build. Now, what about the damage that's already been done? You pull up your credit report and you see them, those ugly little red marks. A 30-day late from last year. Maybe a 60-day late from 2 years ago. Feels permanent like a tattoo. But it might not be. Here's where we get strategic. We're going to perform something I call a goodwill takedown. You are going to write a letter. It's called a goodwill letter. And you send it to the original creditor, the credit card company, the auto lender, not the credit bureaus. In this letter, you are going to be polite, professional, and honest. You explain that you are in the process of applying for a mortgage, and that your past late payment is a significant roadblock. You take full responsibility. You don't make excuses, but you can provide a brief, honest context if there was one: a medical emergency, a job loss, a family crisis. Then you highlight your loyalty. You say, I have been a loyal customer for X years, and as you can see from my record since that incident, I have maintained a perfect payment history. You are asking them as a gesture of goodwill to remove the negative mark from your credit report. Does this always work? No, but it costs you nothing but a stamp and a little bit of time. And I have personally seen this work miracles. I saw one client get a 90-day late removed from Capital One, which shot his score up 72 points in less than a month. You send the letter, you wait, and you might have to send it again. Be persistent, but always be polite. It's a human being on the other end of that letter, and you're asking for a favor. A goodwill takedown is your Hail Mary pass for past mistakes, and it's absolutely worth the shot. Okay, so we've stopped the bleeding with AutoPay, and we've tried to patch up old wounds with goodwill letters. Now we move to the second biggest factor, which is also the fastest way to see a dramatic jump in your score: credit utilization. This is 30% of your score. In simple terms, credit utilization is how much of your available credit you are currently using. If you have one credit card with a $10,000 limit and you have a $3,000 balance on it, your utilization is 30%. It's that simple. Lenders see high utilization as a sign of financial distress. It looks like you're maxed out and living on the edge. Low utilization, on the other hand, shows that you have access to credit but you manage it responsibly. You aren't desperate. The general rule you'll hear everywhere is to keep your utilization below 30%. And that's not bad advice. But we're not aiming for not bad. We're aiming for a mortgage. The real magic, the sweet spot where you see the biggest score increases, is under 10%. Getting your overall utilization under 10% can be like hitting a turbo boost button for your score. So how do we do it? The obvious answer is to pay down your balances. But we need to be strategic. Let's say you have 3 credit cards. Card A has a $500 balance on a $1,000 limit. That's 50% utilization. Card B has a $2,000 balance on a $10,000 limit. That's 20% utilization. And Card C has a $1,000 balance on a $2,000 limit. That's also 50% utilization. Your instinct might be to pay off the card with the highest interest rate, which is smart for your wallet. Or maybe the one with the smallest balance, the snowball method, which feels good psychologically. But for the fastest credit score impact, you attack the cards with the highest utilization ratio. In this case, you throw every extra dollar you have at Card A and Card C to get them under that 30%, and ideally under that 10% threshold first. Lowering those high utilization cards sends a powerful, positive signal to the scoring algorithms. But what if you don't have a pile of cash to pay down the balances right now? This is where we use a little bit of financial jujitsu. It's a counterintuitive move that can have an immediate impact. You're going to ask for a credit limit increase. I know it sounds crazy. You're trying to get out of debt, not get into more. But hear me out. Remember, utilization has 2 parts: your balance and your credit limit. We can't change the balance without cash, but we might be able to change the limit. If you have that card with a $500 balance on a $1,000 limit, your utilization is a high 50%. If you call the credit card company and they increase your limit to $2,000, your balance is still $500, but now your utilization is just 25%. You did nothing but make a 5-minute phone call or click a button in their app, and you instantly slashed your utilization in half. Now, a massive warning comes with this. This is a tool, not a toy. This is not an excuse to spend more money. The second you get that limit increase, you cut up the card, you freeze it in a block of ice, you do whatever it takes to not use that new available credit. This is purely a mathematical play to improve your score. The best candidates for this are cards you've had for a while and have a good payment history with. A simple request can often get you an increase, and the impact on your utilization ratio is immediate. By focusing relentlessly on these 2 areas, perfect, automated on-time payments, and aggressively driving down your credit utilization below 10%, you are directly manipulating the 2 factors that make up 65% of your credit score. This is an abstract theory. This is the targeted tactical work that takes a 600-level score and starts pushing it, week by week, into the territory where lenders start saying yes. We've addressed the immediate emergencies. We've stopped the late payments and we've started to release the pressure from our high utilization debt. But building a truly strong credit profile, one that can withstand the scrutiny of a mortgage underwriter, isn't just about putting out fires. It's about building a fortress. And that means we need to look at the other 35% of your score, the factors that play the long game. Because making a wrong move with them can undo all the hard work we've just started. That's what we're diving into next. The subtle but powerful forces of credit age, new credit and credit mix, and how to master them on your path to buying a home. Think of your credit report not as a document but as a delicate ecosystem. It's a garden you've been tending, consciously or not, for years. And just like a garden, some parts are incredibly sensitive. One wrong move and a decade of growth can be wiped out in an afternoon. The 3 most sensitive, most misunderstood parts of this garden are its age, the introduction of new seeds, and the variety of plants within it. Let's start with the most powerful, yet most fragile element: the age of your credit. This is measured as your average age of accounts. Imagine the oldest trees in your garden, the ones with deep roots, thick trunks, that have weathered every storm. That's your oldest credit card, the one you opened in college and barely use anymore. That's the student loan you've been paying on for a decade. These accounts are the bedrock of your credit score stability. They provide a long history, proving to lenders that you're not a flight risk. They show you can maintain a relationship over time. For FICO, this length of credit history category makes up 15% of your entire score. That's a huge slice of the pie. Here's where people with a 600 score make a catastrophic mistake. They look at their old, unused credit card with its tiny limit and maybe an annual fee and they think, I should clean things up. I'll close this account I never use. This is the credit equivalent of taking a chainsaw to your oldest, strongest oak tree. The moment you close that account, especially if it's your oldest one, two devastating things happen. First, it eventually falls off your report, and your entire credit history suddenly looks shorter. You go from looking like a seasoned veteran of credit to a rookie. Second, and more immediately, you lose that account's history from the calculation of your average age. If you have one account that's 10 years old, and two that are 1 year old, your average age is a respectable 4 years. Close that 10-year-old account and your average age plummets to just 1 year. Your score will nosedive. I once worked with a client, let's call him Mark. Mark had a 640 score. He was on the cusp. He'd done everything right, paid down his balances, made on-time payments. A week before his lender was set to do the final pull of his credit, he decided to tidy up and closed an old department store card he'd had for 12 years. His score dropped 35 points overnight. Just like that, he was no longer eligible for the loan program he wanted. It delayed his home purchase by 7 months, all because he tried to be tidy. So rule number 1, protect your old accounts like family heirlooms. Even if you don't use them, keep them open. Put a small recurring charge on them like a Netflix subscription and set it to autopay. This keeps them active and reporting positively, nurturing the roots of your credit garden. Now let's talk about the opposite of age, new credit. This accounts for 10% of your score, but for someone hovering around 600, its impact feels more like 50%. This is the danger zone. This is where dreams of homeownership go to die. Every time you apply for new credit, a credit card, a car loan, a personal loan, even some buy now, pay later services, it triggers what's called a hard inquiry. Think of a hard inquiry as a small tremor in your credit garden. One tremor isn't a big deal. Your score might dip 3 to 5 points and recover in a few months. But what happens when you have multiple tremors in a short period? It becomes an earthquake. Lenders see a flurry of new applications as a sign of desperation. They think you're in financial trouble and frantically trying to get access to cash. It's a massive red flag. And remember that average age of accounts we just talked about? Every new account you open is a brand new sapling. It drags down your average age, making your entire credit history look younger and riskier. This is the trap. You start the mortgage process, you get a pre-approval letter, and you feel a surge of confidence. You think, great, I'm approved. Now I can finally get that new car I'll need to commute from the suburbs. Or, let me get that Lowe's card so I have 0% financing on a new refrigerator for the house. Stop. This is the single fastest way to get your mortgage denied at the last second. From the moment you decide you want to buy a house until the day you have the keys in your hand, you must become a credit hermit. You go into a self-imposed credit lockdown. No new applications. For anything. I don't care if they're offering you a free flight to the moon. You politely decline. Your goal is to keep your credit report as still and boring as possible. You want to look stable, predictable, and safe. An application spree for new credit screams unstable, unpredictable, and risky. Finally, let's touch on the third component, your credit mix. This also makes up 10% of your score. Lenders like to see that you can responsibly handle different types of debt. There are two main categories. Revolving credit, like credit cards where your balance and payment can change each month. And installment loans like a mortgage, auto loan, or student loan, where you have a fixed payment for a set period of time. Having a healthy mix, say a couple of credit cards and an auto loan, shows you're a versatile borrower. It adds a few points to your score. But here's the crucial warning for someone with a 600 score. Do not go out and get a new type of loan just to improve your mix. The damage from the hard inquiry and the decrease in your average account age will far outweigh any small benefit you'd get from a more varied credit mix. Your strategy right now is not to plant new, exotic flowers in your garden. Your strategy is to nurture what's already there. Work with the mix you have. If all you have are credit cards, that's fine. If all you have is a student loan and one credit card, that's fine too. We are not chasing a perfect score. We are chasing a qualifying score. Don't risk a 20-point drop from a new inquiry just to chase a 5-point gain from a better mix. It's bad math, and it's a gamble you can't afford to take. Now, there is one critical exception to the no inquiries rule. And it's important you know this so you don't get paralyzed by fear. When you're shopping for a mortgage or an auto loan, the scoring models are smart. They know you're going to compare rates from different lenders. So they have a rate shopping window. Any similar inquiries, meaning all mortgage inquiries or all auto loan inquiries, that happen within a 14 to 45-day period depending on the scoring model, are bundled together and treated as a single inquiry on your score. This allows you to shop around for the best interest rate without destroying your credit. So, when it's time to talk to mortgage lenders, you can and absolutely should talk to 3 or 4 of them within a couple of weeks. This is smart shopping. What you can't do is apply for a mortgage on Monday, a car loan on Tuesday, and a Best Buy card on Wednesday. That's not rate shopping, that's a panic signal. So let's put it all together. Your action plan for these 3 subtle but powerful forces is one of preservation and patience. First, you will conduct an audit of your accounts. Identify your oldest account and protect it at all costs. Do not close it. Second, you will enter a credit lockdown. No new applications for any reason until your home loan is closed. Third, you will look at your credit mix, understand it, but you will not try to change it by opening new accounts. You will work with what you have. Your job is to be a patient gardener. Water the plants you have, pull the small weeds of high balances, but don't try to landscape the whole yard a month before the big garden show. Stability is the name of the game. By protecting your credit age, freezing new applications, and maintaining your current credit mix, you're creating that stable, boring, and utterly perfect credit report that a mortgage underwriter wants to see. You're showing them that the person they see today is the same reliable person who will be paying their mortgage for the next 30 years. But what about the bigger problems? What about the ghosts of credit past? The collections, the charge-offs, the late payments that are still haunting your report like stubborn, deep-rooted weeds. Do you pay them? Do you dispute them? Do you just ignore them? The wrong answer can cost you your dream home. In the next part, we're going to war with those negative items, and I'm going to show you which battles to fight and which ones to strategically retreat from. Alright, let's break down the battle plan. The first rule of any conflict is this: know your enemy. You can't just charge in guns blazing at every single negative item on your credit report. That's how you lose. You need intelligence. You need a strategy. So, before you write a single dispute letter, you're going to perform reconnaissance. You're going to triage the battlefield. Pull up that credit report we talked about. Look at every single negative mark. We're going to sort them into 3 categories. Category 1. The ghosts in the machine. These are the most obvious targets. This is debt that isn't yours. A name that's spelled wrong, an address you've never lived at, a Capital One card when you've only ever banked with Chase. These are clear factual errors. They are your number 1 priority. They are the easiest to fight and the quickest to win because the burden of proof is entirely on the credit bureau, and there is no proof. Category 2. The twisted truths. These are accounts that are yours but the information is wrong. It says you were 90 days late but you were only 30. It shows a balance of $5,000 but you paid it down to $500. It's listed as a charge-off but you actually settled the account. These are inaccuracies tied to legitimate debts. They require more finesse because you're not disputing the existence of the account, you're disputing the details. These are your second priority. Category 3. The ugly truths. These are the legitimate negatives. You missed that car payment. You defaulted on that old store credit card. The medical bill went to collections. These are accurate, they are yours, and they are damaging. Fighting these with a standard dispute saying "not mine" is not only pointless. It can actually hurt you by confirming the debt is yours in the system. We have a completely different strategy for these which we'll get to, but for now just identify them. Now here is the single most important piece of strategic advice I can give you, and it's going to sound completely backward. Sometimes the smartest move is to do nothing at all. You have to learn which battles to avoid. Specifically, I'm talking about small old collection accounts. Let's say you have a medical collection from 4 years ago for $150. Sitting there on your report hurting your score. Your first instinct is to call them up and pay it, or to dispute it to try and get it removed. Stop. Don't do it. You could be waking a sleeping giant. See, mortgage credit scores, the FICO models that lenders actually use, are incredibly sensitive to the age of negative information. An old collection from 4 years ago is a faded scar. It's not great, but the damage is mostly done. The moment you contact the creditor, make a payment, or even engage in a dispute that gets re-verified, you risk updating the date of last activity on that account. In the eyes of the scoring model, that 4-year-old scar can suddenly look like a fresh, bleeding wound. You could see your score drop 20, 30, even 50 points right when you need it most. For a small debt that old, many underwriters will overlook it anyway. The risk of re-aging it is far greater than the reward of removing it. So for small, old collections, think anything over 2 or 3 years old and under a few $100. Our strategy is often strategic retreat. We leave it alone and focus on bigger targets. Your primary targets are the ghosts and the twisted truths. These are the battles you can win. So how do you fight? You don't use the simple online dispute button on the credit bureau's website. That is the equivalent of sending an angry email into the void. It's designed for their convenience, not your success. It often forces you into drop-down menus that don't fit your situation, and it limits your ability to provide evidence. We are going to use the financial equivalent of a guided missile. A physical dispute letter sent via certified mail with return receipt requested. Why? Because it's all about creating a paper trail. When the credit bureau signs for that letter, the clock starts ticking. Under the Fair Credit Reporting Act, or FCRA, they have a legal obligation to investigate your claim, typically within 30 days. That certified mail receipt is your proof. It's your leverage. It shows them you are serious and you know your rights. Your dispute letter needs to be a surgical instrument, not a sledgehammer. No emotion. No long sob stories about how the debt wasn't your fault or how you were going through a hard time. The person reading your letter is a low-level data processor looking for 2 things: an account to investigate and a reason why. That's it. Your letter should be simple and factual. At the top, put your full name, address, social security number, and date of birth. Clearly state that you are writing to dispute an item on your credit report. Then list the item. For example, I am disputing the following account: XYZ Collection Agency, account number 12345. Then, in 1 or 2 clear sentences, state why you are disputing it. This account is not mine. I have never had a business relationship with this company. Or, this account is inaccurate. The balance should be 0, as I paid this account in full on May 15, 2022. I have attached a copy of the bank statement showing the cleared payment. Finally, you state your desired outcome. Please investigate and remove this inaccurate item from my credit file immediately. That's it. Clear, professional, and to the point. You'll send a separate letter for each of the 3 bureaus, Equifax, Experian, and TransUnion, because they are separate companies and don't share dispute information. Once you mail those letters, the 30-day waiting game begins. The bureau will contact the creditor who reported the information and ask them to verify it. One of 3 things will happen. Outcome 1, the best case: the creditor doesn't respond in time, or they can't find the records to prove the debt is accurate and yours. Victory: the credit bureau is legally required to delete the negative item from your report. You'll get a letter in the mail confirming the deletion, and you should see your score jump. Outcome 2, the neutral case: the information is updated. They agree you were only 30 days late, not 90, and they correct it. This is a partial win. It helps, but the late payment is still there. Outcome 3, the frustrating case: the item is verified. The creditor sends back a digital confirmation saying, "Yep, it's accurate," and the credit bureau considers the case closed. This is where most people give up. But this is not the end of the road. If you know for a fact the item is an error, your next step is to go over the credit bureau's head and file a complaint with the Consumer Financial Protection Bureau, the CFPB. But that's a later stage of the war. Now, what about those ugly truths? The negatives that are 100% accurate? Disputing them as not mine is a waste of time. For these, we use a different tactic: the goodwill letter. This is for late payments on an otherwise positive account. Let's say you have a car loan you've paid perfectly for 3 years, but you missed one payment 6 months ago because of a bank error or a family emergency. You write a polite, humble letter directly to the creditor, not the credit bureau. You explain your history of on-time payments, briefly and professionally explain the circumstance of the one-time lapse, and you ask for a goodwill adjustment to remove the late payment from your credit history. You are not demanding anything. You are asking for a courtesy based on your good history. It's a long shot. Most companies have a policy against it, but it costs you a stamp, and if it works, it can boost your score significantly. It is a low-risk, high-reward maneuver that is always worth trying. So your mission is clear. Triage the report. Identify the ghosts and twisted truths as your primary targets. Ignore the small, old collections. Prepare your factual, unemotional dispute letters and send them via certified mail. For any accurate, one-off late payments, send a goodwill letter to the creditor. You've now officially gone on the offensive. You've launched your first volley. While you wait for the bureaus to complete their 30-day investigation, we can't just sit on our hands. The clock on your home purchase is ticking. Cleaning up the past is only half the battle. Now we have to start building the future, and we have to do it fast. While those letters are in the mail, we're going to open up a second front in this war. Aggressively building new, positive credit that will show up on your report right when you need it most. This is not a passive waiting game. This is an active, two-front war for your financial future. While we're carpet bombing the credit bureaus with dispute letters, we're simultaneously airdropping in new positive reinforcements. The goal is to have the old negative junk fall off your report at the exact same time that new, pristine, positive accounts start showing up. It's a shock and awe campaign designed to fundamentally transform how lenders see you in the shortest time possible. Now let's be honest. If you have a 600 credit score, the idea of opening new lines of credit probably sounds terrifying. It feels like handing a bottle of whiskey to a recovering alcoholic. You're thinking, isn't more credit what got me into this mess in the first place? I get it. The fear is real. You've been told no so many times that applying for anything feels like setting yourself up for another painful rejection. But you have to reframe your thinking. We are not getting new credit to go on a shopping spree. We are not buying things we can't afford. We are acquiring strategic tools. Think of them as precision instruments, not sledgehammers. The purpose of these new accounts is singular: to generate positive payment history. That's it. They are factories whose only product is a monthly paid-on-time notification sent to all 3 credit bureaus. And we're going to run these factories with ruthless robotic efficiency. Our first tool, our primary weapon on this second front, is the secured credit card. This is, without a doubt, the single most powerful credit-building tool for someone in your position. Here's why it's practically magic. A traditional credit card is based on a bank's trust in you. With a 600 score, that trust is low. A secured card removes trust from the equation entirely. Instead, you give the bank a security deposit. You might give them $200 or $300 or $500. That deposit becomes your credit limit. You give them a $300 deposit, you get a credit card with a $300 limit. From the bank's perspective, this is a zero-risk proposition. If you max out the card and disappear, they just keep your deposit. No harm, no foul. Because there's no risk for them, approval odds are incredibly high. Even with a low score, recent bankruptcies, or collections, you are almost guaranteed to be approved. And here's the most important part. On your credit report, a secured card looks almost identical to a regular, unsecured credit card. The bureaus don't really differentiate. All they see is a new, revolving line of credit. A new opportunity for you to prove yourself. So how do you use it? First, you need to find the right one. You're looking for a card with no annual fee, or a very low one that, and this is non-negotiable, reports to all 3 credit bureaus: Equifax, Experian, and TransUnion. Some predatory lenders only report to 1 or 2, which kneecaps your efforts. Cards like the Discover It Secured or the Capital One Platinum Secured are popular starting points because they check these boxes and can even graduate to a regular unsecured card after you've proven yourself, at which point you get your deposit back. Once you're approved and the card arrives in the mail, you will do the following. You are going to take one small, recurring monthly bill, think your Netflix subscription for $15 or Spotify for $11, and you are going to link this new card as the payment method. Then you are going to put the physical card in a drawer, freeze it in a block of ice, give it to your grandma to hide, I don't care. You will not use it for gas, for groceries, for anything else. Its only job is to pay that one tiny bill every month. Next, you will log into your new online account and set up autopay. But you're not going to set it to pay the minimum. You are going to set it to pay the full statement balance every single month automatically. This is the holy grail. By doing this, you guarantee 2 things. You will never pay a penny in interest, and more importantly, you will have a perfect on-time payment reported to the credit bureaus every single month like clockwork. This simple act accomplishes something profound. It starts to overwrite your old story of missed payments with a new story of flawless reliability. And we're going to supercharge its effect. One of the biggest factors in your credit score is called credit utilization. It's the percentage of your available credit that you're using. For a perfect score, you want to keep this number as low as possible, ideally under 10%. By only charging $15 on your new $300 secured card, your utilization on that card is just 5%. It's perfect. You're showing the scoring models that you have access to credit, but you're so responsible you barely even need to use it. That's weapon number 1. Now for weapon number 2, which creates a powerful 1-2 punch. the credit builder loan. This might sound even stranger than a secured card, but stick with me. A credit builder loan works in reverse. With a normal loan, a bank gives you money, and you pay it back over time. With a credit builder loan, you don't get any money up front. Instead, the lender puts the loan amount, say $500, into a locked savings account that you can't touch. You then make small monthly payments to the lender over a set term, maybe 12 or 24 months. For a $500 loan over 12 months, you might pay about $42 a month. Each one of those $42 payments is reported to the credit bureaus as an on-time installment loan payment. At the end of the 12 months, after you've made all the payments, the bank unlocks the savings account and gives you your $500 back, sometimes with a little bit of interest. Do you see the genius of this? You're essentially paying yourself. It's a forced savings plan that simultaneously builds your credit history. You end up with $500 in cash and 12 months of perfect payments on your credit report. The risk for the lender is almost zero, so again, these are very easy to get approved for. Companies like Self or Credit Strong, or your local credit union are fantastic places to find these. So why do both? Why get a secured card and a credit builder loan? Because of something called credit mix. Your score is rewarded for showing that you can responsibly handle different types of credit. A credit card is revolving credit. A loan is installment credit. By having both, you're showing the mortgage underwriter that you have experience with the exact kind of credit a mortgage is, a long-term installment loan, while also demonstrating day-to-day discipline with revolving credit. It makes you look like a much more stable, well-rounded borrower. This is the pincer movement. While your dispute letters are attacking the negative history, your new secured card and credit builder loan are building a fortress of positive history. Imagine the mortgage lender pulling your report in 3 or 4 months. They're expecting to see a battlefield littered with collections and late payments. But instead, they see a clean slate where the bad stuff used to be, and on top of it, 2 brand new accounts, a revolving card and an installment loan, both with a few months of flawless on-time payments and super low utilization. The narrative has completely changed. You're no longer the person who used to mess up. You are now the person who is actively, demonstrably, and currently responsible with their finances. It doesn't just raise your score. It changes the entire story your credit report tells about you. It's the difference between an application that gets a hard no and one that gets a yes. Let's talk about your options. We've now officially engaged on all fronts. We're fighting the past with our disputes, and we're building the future with our new positive credit. But there's one final piece of this puzzle that we haven't touched yet, and it's arguably the most intimidating of all. It's the cold hard cash, the down payment, the closing costs, the reserves. Because even with a perfect credit score, you can't buy a house with an empty bank account. So while our credit building machine hums along in the background, we need to turn our attention to the financial boot camp that will get your savings ready for the biggest purchase of your life. Alright, soldier, welcome to Financial Boot Camp. This is where the dream of homeownership gets real. It's where we separate the window shoppers from the future key holders. Because a lender, especially when they see a 600 range score, isn't just looking at your past. They're trying to predict your future. And the most powerful crystal ball you can hand them is a healthy bank account. This isn't just about saving money. It's about building a fortress of financial stability around your application. It's about forging the evidence that proves you are ready for this. So, how much evidence do you need? What's the magic number you need to have saved up? Well, it's not one number. It's 3. Think of it as a 3-headed monster you have to conquer before you can claim the castle. Its names are the down payment, the closing costs, and the cash reserves. You have to defeat all 3. Let's break down the battle plan for each one. First, the down payment. This is the one everyone knows about, but it's also the one surrounded by the most myths. For decades, we've had the 20% down rule beaten into our heads. Let me be clear. For a $300,000 house, that would be $60,000. If that was the only way, this video series wouldn't exist. That rule is a ghost. It's a relic from a different era. Today we have weapons that ghosts never dreamed of. For a buyer with a credit score in the 600s, your most powerful and most likely weapon is the FHA loan. The Federal Housing Administration loan. The FHA loan is like a cheat code for first-time buyers, and its magic number isn't 20%. It's 3.5%. Let's run the numbers on that same $300,000 house. 3.5% of $300,000 is $10,500. Now, I'm not saying that's a small amount of money. It's a serious chunk of change. But compare it to $60,000. It's not just in a different ballpark. It's a different sport. Suddenly, the impossible starts to feel possible. That's your first target. $10,500. That's the head of the first beast. But just when you've slain one, the second one lunges from the shadows. This is the one that ambushes most first-time buyers. It's the silent killer of homeownership dreams. Closing costs. What are closing costs? They are the collection of fees you have to pay to finalize the mortgage. Think of it as the processing and handling fee for the biggest purchase of your life. This includes things like the lender's origination fee, the appraisal fee to make sure the house is worth what you're paying, the title insurance to make sure the seller actually has the right to sell it, attorney fees, recording fees for the county, the list goes on. It feels like a dozen different hands are all reaching into your pocket at once. So how much is it? The rule of thumb is that closing costs will run you anywhere from 2% to 5% of the purchase price. It varies by state, it varies by lender, but that's the battlefield. For our $300,000 example, let's take a conservative average of 3%. That's another $9,000. So now you're looking at $10,500 for the down payment, plus $9,000 for closing costs. We're at $19,500. This is the point where a lot of people feel the air gets sucked out of the room. They see that number and they think, I'm out. I can't do this. But wait, remember we're in a boot camp. We don't retreat. We find new strategies. For closing costs, there's a powerful negotiation tool called seller concessions or seller credits. This is where you, the buyer, ask the seller to pay for some or all of your closing costs. Why would they do that? Well, to make the deal happen. You might offer them their full asking price of $300,000, but ask for $9,000 or 3% back in concessions to cover your costs. Essentially, the closing costs get rolled into the loan amount. This is a game changer. For a buyer with a lower credit score and limited cash, this strategy is not just a nice to have. It's often a necessity. It's a critical piece of intel you need to have in your back pocket when you start making offers. It means your primary cash saving target remains that down payment. Okay, 2 heads down. 1 to go. But this last one, this is the one that separates the approved from the denied. It's the one that most people don't even know exists until a loan officer asks them for it. It's your cash reserves. Cash reserves are the money you have left in your bank account after you've paid your down payment and your closing costs. This is your emergency fund. This is your life happens fund. The lender needs to see this. Why? Because they are taking a risk on you. Your 600 range score already tells them you've had some financial stumbles in the past. What they need to see, what you have to prove to them, is that you have a safety net. What happens if the water heater explodes the month after you move in? What if you get sick and miss a week of work? The lender needs to know that you won't immediately default on your mortgage at the first sign of trouble. Cash reserves are their proof. They are your credibility. For a borrower with a 780 credit score, reserves might be a suggestion. For a borrower with a 600 credit score, they are a commandment. How much do you need? The requirement is usually stated in months of your total monthly housing payment. That payment is often called PITI, principal, interest, taxes, and insurance. Lenders will typically want to see anywhere from 2 to 6 months of PITI sitting in your account after closing. Let's say the PITI on our $300,000 house is around $2,200 a month. If the lender requires 3 months of reserves, that's another $6,600. This money stays with you. You don't pay it to anyone. It just has to be there, sitting in your account, acting as the final piece of evidence that you are a responsible borrower. So let's do the final tally, the full financial picture. Using our example, $10,500 for the down payment, $9,000 for closing costs, which we'll try to get the seller to cover, and $6,600 for cash reserves. If you can't get seller concessions, you need to be prepared to bring $26,100 to the table. If you can negotiate those seller credits, your cash needed drops to $17,100. Take a breath. Look at that number. It's real. It might be scary, but it is not a monster. It's a mountain, and any mountain can be climbed one step at a time. The key is to stop looking at the peak and start focusing on the path right in front of you. So how do we start the climb? How do we build that war chest? It starts with a full-scale assault on your budget. I call this the budget autopsy. For the next 30 days, you are a financial detective. You track every single dollar that leaves your possession. Not just the big bills, every coffee, every subscription, every impulse buy on Amazon. You write it all down. At the end of 30 days, you're going to look at that list and you will be shocked. You'll find the cash leaks. You'll see the $5 a day habit that's costing you $1,500 a year. That's your target. Next, you implement the Pay Yourself First mandate. This is non-negotiable. The moment your paycheck hits your account, a preset, automated transfer moves money into a separate, high-yield savings account. An account you label Future House. Don't wait to see what's left at the end of the month. You pay your future self first before you pay Netflix, before you pay for takeout. Even if it's only $50 a paycheck to start. The automation is key. It removes willpower from the equation. It turns saving from a choice into a fact. And finally, you launch the Side Hustle Sprint. For the next 6 to 12 months, your free time is an asset. Can you drive for a rideshare service? Deliver food? Walk dogs? Do you have a skill you can freelance online, writing, graphic design, bookkeeping? Can you pick up a weekend shift at a local store? Think about it. An extra $500 a month is $6,000 a year. That's a massive chunk of your savings goal. This isn't forever. It's a temporary focused sprint with a huge prize waiting at the finish line. This is the work. It's not glamorous. It's a grind. There will be days you want to quit. But every dollar you save is another brick in your fortress. Every sacrifice you make is a vote for your future. You are not just saving money. You are changing your life. You are proving to the lenders, but more importantly to yourself, that you are ready. Now that you know exactly how much cash you need and have a battle plan to save it, we need to prepare the other side of your application. Because having the money is only half the battle. You also need the paper trail to prove where it came from and to verify every other detail of your financial life. Lenders are going to put you under a microscope, and if your documents aren't pristine and in order, all this saving will be for nothing. You could have $50,000 in the bank, but if you can't properly document it, it might as well be zero. So let's talk about how you make that $50,000 in the bank actually count. You do it by preparing for the financial equivalent of a full-body cavity search. It's called underwriting, and it's the phase where lenders verify every single claim you've made about your financial life. For a borrower with excellent credit, this is a routine checkup. For you, with a 600 credit score, it's an interrogation. The underwriter isn't your friend. Their job is to protect the lender's money, and they do that by finding reasons to say no. Your job is to give them 0 reasons. This all comes down to one word: sourcing. Every significant dollar in your bank account needs a story. A clear, verifiable, paper-trailed story. Let's start with the biggest landmine: large deposits. Lenders will typically ask for your last 2 to 3 months of bank statements for every account you have, checking, savings, everything. They will scan these statements line by line, and their eyes are trained to spot any deposit that looks out of place. What's out of place? Anything that isn't your regular, recurring payroll deposit. Let's say your uncle gives you $10,000 in cash to help with the down payment. You're thrilled. You go to the bank and deposit it. In the eyes of an underwriter, you might as well have just set off a flare gun in their office. That $10,000 is now a large, unsourced deposit. They have no idea where it came from. Was it a loan you have to pay back? If so, that's an undisclosed debt that affects your debt-to-income ratio. Was it from illegal activities? They have to consider that. Is it just mattress money you've been saving for years? They can't prove that, so to them it doesn't exist. Any cash deposit is toxic to your mortgage application. So how do you handle that $10,000 from your uncle? The right way. First, you never ever deposit large amounts of cash. Instead, your uncle needs to write you a check or wire the money directly to your account. Second, and this is non-negotiable, he needs to sign a gift letter. This is a simple one-page document provided by the lender that states his name, your name, the amount of the gift, and a sentence that explicitly says, "This is a bona fide gift, and there is no expectation of repayment." He signs it, you sign it, but it doesn't stop there. You then have to prove he had the ability to give the gift. This means your uncle will have to provide his bank statement showing the $10,000 leaving his account. Yes, you have to ask a family member for their private financial documents. It's awkward, it's invasive, but it's the price of admission. Without that paper trail, the gift letter and the donor's bank statement, that $10,000 is useless. The underwriter will back it out, meaning they'll subtract it from your total assets and pretend it's not there. If that money was essential for your down payment or closing costs, your loan is dead on arrival. Next up is income verification. This is where the 2-year rule comes into play. Lenders want to see stability, and the industry standard for that is 2 years of consistent employment history. You'll need to provide your most recent 30 days of pay stubs, your W-2s from the past 2 years, and often your full federal tax returns for the past 2 years, including all schedules. They're looking for consistency. If you've been at the same job for 5 years getting paid a similar amount, that's a green light. But what if you're part of the gig economy? A freelancer, an Uber driver, a self-employed contractor? Buckle up. You don't have W-2s. Your income is shown on a 1099. For a 600 credit score borrower, this is like climbing the mountain in flip-flops. You will need, at minimum, your last 2 years of business and personal tax returns. The underwriter will average the net income. That's your income after all your write-offs and expenses from those 2 years. If you made $80,000 in 2022 but wrote off so many expenses that your taxable income was only $30,000, then in the lender's eyes you made $30,000. It doesn't matter what hit your bank account. The only thing that matters is the number you reported to the IRS. You'll also need to provide a year-to-date profit and loss statement, or P&L, and multiple months of business bank statements to prove your current income is consistent with the past. It's a mountain of paperwork designed to prove that your fluctuating income is, in fact, stable. Then there are the explanations. With a 600 score, your credit report isn't clean. The underwriter is going to see late payments, collections, and charge-offs. They're also going to see every credit inquiry you've had in the last few months. For every single blemish, you will likely have to write a letter of explanation, or LOX. This is a formal letter where you explain what happened. This is not the time to write a novel about how your ex wronged you or your old boss was a jerk. A letter of explanation needs to be 3 things: brief, factual, and remorseful. For a late payment on a credit card from a year ago, you might write, "Regarding the 30-day late payment to Capital One in May 2023, this was an oversight on my part during a period of travel. I have since enrolled in AutoPay to ensure all future payments are made on time, and this will not happen again." That's it. You stated the issue, you took responsibility, and you outlined the corrective action. You don't make excuses. You don't blame anyone. You own it. You will have to do this for multiple items. Why did you apply for 3 credit cards in the last 6 months? Write a letter. What is that medical collection from 2 years ago? Write a letter. Each letter is another chance to demonstrate that the past is the past, and you are a reliable, responsible borrower now. So you've gathered your bank statements, sourced your gift funds, compiled 2 years of income history, and written a dozen letters of explanation. You send this mountain of paper to your loan officer. They pass it to a loan processor who packages it up neatly. And then it goes to the underwriter. The underwriter will review every single page. And then they will come back with questions. They always do. These are called conditions. A condition might be, please provide the first page of your 401k statement to prove you have access to the funds you listed. Or, the deposit on June 5th for $850 does not match your payroll. Please source these funds. Or, please provide an updated pay stub, as the one on file is now more than 30 days old. Your response time here is critical. The underwriter gives you a request, you get them the document that same day if possible. Every day you delay is another day you might miss your closing date, which can kill the entire deal. During this period from pre-approval to closing, your financial life must be frozen in carbonite. Do not make any large purchases. Do not finance a new car, new furniture, or a new laptop. Any new debt will alter your debt-to-income ratio and can cause the underwriter to deny your loan at the last minute. Do not change jobs. Even if it's for a promotion and more money, it introduces a variable, and underwriters hate variables. Wait until after you have the keys. Do not move money around between your accounts. It just creates a confusing paper trail that you'll have to explain. Pick one account for your down payment and closing costs and leave it there. And for the love of all that is holy, do not deposit any cash. This entire process, from submitting your documents to getting the final clear to close from the underwriter, can take weeks. It's a nerve-wracking, painstaking gauntlet of paperwork. But every document you provide, every explanation you write, is a brick you're laying in the foundation of your case. You are proving, against the odds of your credit score, that you are a worthy risk. When that final approval comes through, it feels like you've just won a war. But all you've really won is the right to go into the next battle. Because now, with that pre-approval letter in hand, you have to actually go out and find a house in a market that might not be too friendly to a buyer with your kind of financing. And this is where the theoretical part of the journey ends, and the brutal real-world part begins. You're stepping onto a battlefield, and you need to understand you're not just an underdog. In the eyes of many sellers, you're a high-risk gamble. Let's be painfully honest about what you're up against. In a competitive market, you'll likely be competing against buyers with conventional loans, huge down payments, and even all-cash offers. Their financing is seen as a sure thing. Yours, with a 600 credit score and an FHA loan, is seen as a question mark. So you start the hunt. You're scrolling Zillow, you're going to open houses. You're filled with this nervous excitement. You walk into a house and it happens. You fall in love. You can see your furniture in the living room. You can smell the coffee brewing in the kitchen. You can imagine your life unfolding within those four walls. Your real estate agent helps you craft an offer. You offer the asking price, maybe even a little bit more. You cross your fingers, you pray, you do whatever you need to do, and you wait. And then the call comes. They went with another offer. Your stomach drops. It's a gut punch. You ask your agent, why? Was our offer too low? And your agent might tell you something you weren't expecting. No, your price was great. They were just nervous about your financing. This is the first lesson of house hunting with a 600 score. Your offer isn't just about the price. It's about the perceived certainty of that price. A seller looks at two offers for the same amount. Offer A is a conventional loan with 20% down from a buyer with an 800 credit score. Offer B is your FHA loan with 3.5% down and a 600 credit score. To that seller, offer A looks like a signed, sealed, delivered check waiting to be cashed. Offer B looks like a lottery ticket that might or might not be a winner. They're worried your loan will fall apart in underwriting. They're worried about the stricter FHA appraisal requirements. Let's talk about that FHA appraisal because it's a massive hurdle you need to be aware of. The FHA isn't just concerned with the value of the home. They're concerned with its safety and livability. They have what's called minimum property standards. So, an appraiser will come out and they're not just looking at square footage and comparable sales. They're looking for peeling paint, especially if the house was built before 1978, because of the risk of lead. They're looking for handrails on any flight of stairs with more than a few steps. They're checking for leaky roofs, functioning utilities, and any signs of structural damage. If the appraiser flags any of these issues, they have to be fixed before the loan can close. And who pays for that? The seller. Now imagine you're that seller. You have one offer that requires you to potentially spend thousands of dollars scraping paint and installing handrails, and another offer from a conventional buyer where the appraiser doesn't care about any of that. Which one are you going to choose? The path of least resistance. The path of least cost and least hassle. Every single time. This is the reality you'll face. You will likely lose out on multiple houses. You'll write offer after offer. You'll get your hopes up, only to have them crushed. This is the grind. This is the phase where so many people with lower credit scores give up. They get beaten down by rejection and start to believe that homeownership is impossible for them. They see it as a sign. But it's not a sign. It's a test. It's a test of your resolve, your patience, and your strategy. Because you can't win this fight by playing the same game as everyone else. You have to play a different game. You have to be smarter, more strategic, and more resilient. So how do you do it? How do you make your offer, the lottery ticket offer, look more appealing? First, you need a real estate agent who is a stone-cold expert in FHA loans. Do not just go with your cousin who got their license last year. You need an agent who has closed dozens of FHA deals, who understands the appraisal process inside and out, and who knows how to communicate your strengths to the seller's agent. A great agent can call the listing agent and sell you. They can say, listen, I know it's an FHA loan, but my clients are rock solid. They've been through rigorous underwriting for their pre-approval. Their debt-to-income is low, and they have stable job history. They're not a risk. They're a family who fell in love with this house. That advocacy is priceless. Second, you write a personal letter to the seller. I know it sounds cheesy, but in a world of faceless transactions, a human connection can be a powerful tiebreaker. Tell them who you are. Tell them what you love about their home. Don't talk about how you're getting a great deal. Talk about how you can't wait to host Thanksgiving in their dining room or watch your kids play in the backyard they so clearly loved. You're not just buying a property. You're asking to become the next steward of their home, a place filled with their memories. Appeal to their heart, not just their wallet. Sometimes that's all it takes for a seller to choose your story over someone else's numbers. Third, get strategic about the properties you target. If a house is brand new on the market, absolutely gorgeous and priced perfectly, it's going to get a dozen offers in 48 hours. Cash buyers and conventional loans will win that war every time. You need to be a smarter shopper. Look for houses that have been on the market for 30, 45, or even 60 days. Why? Because the seller is likely getting nervous. The initial flood of interest has dried up. They're more motivated and might be more willing to work with an FHA offer. Look for homes that are solid and well-built, but maybe need some cosmetic updates. The buyers looking for a perfect HGTV-ready home will pass on it, but it might be perfect for you and pass an FHA appraisal with flying colors. You're looking for the hidden gems, not the crown jewels that everyone is fighting over. Fourth, make your offer as clean as possible in other ways. Can you be flexible on the closing date to match the seller's timeline? Can you offer a slightly larger earnest money deposit to show you're serious? Every little bit helps. You need to remove as many potential objections as you can. Your financing is already one big hurdle. Don't add more by making difficult requests for closing costs or including a long list of contingencies. This process is a marathon of emotional management. You will feel frustrated. You will feel defeated. You will start to think your credit score is a brand on your forehead that every seller can see. But then one day it happens. You find the right house with the right seller at the right time. You put in your offer, you attach your letter, your agent makes the call, and you hold your breath. And the phone rings. It's your agent. And you hear the words you started to think you'd never hear. They accepted your offer. The relief is overwhelming. It's this incredible wave of joy, validation, and pure, unadulterated excitement. All the spreadsheets, the rejections, the late-night Zillow scrolling, the anxiety, it was all worth it. You did it. You fought your way through the most difficult part of the process and you won. You're officially under contract to buy a home. The celebration, however, has to be short-lived, because you've just crossed the starting line of the final, most nerve-wracking leg of the race. The journey from contract to closing. This final stretch is where more deals fall apart for buyers with lower credit scores than at any other point in the process. Why? Because the scrutiny you've faced so far was just the preliminary round. Now you're being handed over to the final boss. The underwriter. The underwriter is not your friend. They are not a salesperson. Their entire job is to protect the lender's money by poking holes in your application. They are a financial detective, and you are their one and only case. They will re-verify everything. Your job, your income, your bank statements, your credit history, it all goes under the microscope one more time, but with a much higher magnification. For the next 30 to 45 days, you need to live like a financial monk. Your life is now a minefield, and one wrong step can detonate your dream of homeownership. So listen closely. This is the survival guide. First, do not, under any circumstances, change your employment. Don't quit your job. Don't get fired. And believe it or not, don't even take a promotion or switch to a better paying company if you can help it. To a lender, consistency is king. A new job, even a better one, introduces a new variable. It means a new probationary period. It means your income stream, which they just approved, has changed. If you absolutely must change jobs, you need to talk to your loan officer before you even give notice. Second, your wallet is now a museum. Look but don't touch. Do not open any new lines of credit. I don't care if the furniture store is offering 0% financing for the new sofa you want. I don't care if you get a pre-approved offer for a great new credit card. Do not apply for a car loan. Do not finance anything. Every time you apply for new credit, it dings your credit score, and more importantly, it adds a new monthly debt payment, which instantly changes your debt-to-income ratio. That ratio is the mathematical foundation your entire approval was built on. Changing it is like pulling a block from the bottom of a Jenga tower. Third, become obsessed with paper trails. Do not make any large, unusual deposits into your bank account without talking to your lender first. That $20,000 your parents are gifting you for the down payment? It needs a gift letter. A signed document stating it's a gift and not a loan that needs to be repaid. That $5,000 you got from selling your car on Craigslist? You need a bill of sale and a copy of the check. Any cash deposit over a few $100s is a massive red flag. To an underwriter, undocumented cash isn't a gift. It's a secret, undisclosed loan that could jeopardize your ability to pay your mortgage. You have to prove where every single dollar came from. Fourth, and this should be obvious, but it's the #1 deal killer. Do not miss a single payment on any of your existing debts. Not a credit card payment, not a car payment, not your rent. Set them all to autopay right now. A single 30-day late payment reported to the credit bureaus during this period is practically a guaranteed denial. It's a signal to the underwriter that you can't handle your current debts, let alone a massive new mortgage. And finally, do not spend the money you've saved for closing. In fact, you should keep saving. The cash to close figure you were given is an estimate. It can change. You need a buffer. Don't go on a vacation. Don't buy a new TV. Your savings account is now locked in a vault until closing day. As you navigate this minefield, the underwriter will be working. And one day, you'll get an email from your loan officer. Your heart will leap, but it won't say approved. It will likely say conditionally approved. This is a good sign, but it's not the finish line. It means the underwriter is willing to sign off on your loan. If you meet a list of conditions, this list can be 1 item long or 20 items long. It will feel personal. They might ask for a letter of explanation. For a credit inquiry from 2 years ago, you'll have to write a signed letter explaining, "I was shopping for car insurance rates and had no intention of opening new credit." They might want to see your last 2 months of bank statements again, even though you already sent them. They might want a letter from your landlord verifying you've paid rent on time for the past 12 months. Whatever they ask for, your job is to get it to them as fast as humanly possible. Don't complain. Don't delay. Every day you wait is a day you're not closing. While you're chasing down documents, another critical event is happening in the background. The appraisal. The lender will hire an independent appraiser to determine the official value of the home. This isn't for you, it's for them. They need to ensure the house is worth the price you're paying, so they're not lending you more money than the asset is worth. You'll just be holding your breath, waiting for the report. If the appraisal comes in at or above the purchase price, you've cleared a massive hurdle. But what if it comes in low? This is a moment of pure panic. If you agreed to pay $300,000, but the appraiser says it's only worth $290,000, the lender will only give you a loan based on the $290,000 value. That $10,000 gap has to be bridged. You have 3 options. The seller can agree to lower the price to the appraised value, you can come up with the extra $10,000 in cash, or you can negotiate to meet somewhere in the middle. If no one budges, the deal can die right there. But let's say you survive the conditions. You survive the appraisal. You've done everything right. You're a few days from closing. You'll do one final walkthrough of the property to make sure it's in the same condition as when you made the offer. And then you wait for the 3 most beautiful words in the English language. Clear to close. When you get that call or email, the weight that lifts off your shoulders is indescribable. It's the official green light. The lender has done all its checks, the underwriter is satisfied, and the funds are ready. You've made it. The final step is the closing table. You'll sit in a sterile office with your agent, maybe the seller, and a closing agent or attorney. You'll be presented with a stack of paper so thick it could stop a bullet. You'll sign your name over and over again, initialing page after page until your hand cramps. You'll sign the promissory note, legally obligating you to repay this massive loan. You'll sign the deed of trust, giving the lender the right to foreclose if you don't. It's intimidating, but at the end of it all, you'll hand over the biggest check of your life, and someone will slide a set of keys across the table. They're your keys. Take a moment and think back. Think back to the person with the 600 credit score who thought this was impossible. The person who was afraid to even check their report. The person who scraped together every dollar for a down payment, who fought off other buyers, who survived the underwriting gauntlet. That person just became a homeowner. The journey wasn't just about buying a house. It was about proving to yourself that you could overcome a number, a past mistake, and achieve something incredible. But this isn't the end. It's the start of a new, even more important journey. Staying a homeowner and building real wealth. That 600 score got you in the door, but it also came with a higher interest rate. The mission now is to transform your financial life. Here are the first 3 things you must do. 1. The day you get your first mortgage statement, set up automatic payments. This is not optional. Your mortgage payment is now the most important bill in your life. 2. Continue the exact same habits that got your score up in the first place. Keep credit card balances low, pay everything on time. The goal is to get your credit score into the 700s over the next 12 to 24 months, so you can refinance your mortgage to a much lower interest rate, potentially saving you hundreds of dollars every single month. And 3. Start a dedicated home maintenance savings account. The water heater will fail. The AC will break. These are no longer a landlord's problem. They are yours. Being prepared for them is the key to long-term success. Buying a house with a 600 credit score is hard. It's stressful. It requires discipline and sacrifice. But it is a testament to the fact that your credit score is not your identity. It's a temporary condition, not a life sentence. You didn't just buy a property, You took control of your future. And that is a foundation worth building on.